The guy who drives around town with a paid-off car and no credit card debt is not winning. He is quietly losing a race he doesn't know he entered. I'm going to show you the exact number he's losing by, and it's not a small number. It's the kind of number that changes your entire relationship with the concept of debt. And by the end of this video, you're going to understand something that most people with finance degrees still get subtly wrong. Zero debt is a feeling. It's not a strategy. And the financial industry, including the people who sell you the idea that being debt-free is the ultimate achievement, has a very specific incentive to keep you in that feeling. Here's the thing. Americans have been trained systematically and deliberately to fear debt the way they fear public speaking or flying. The word itself, debt, carries a moral weight that has nothing to do with math. People don't say, I have a debt to equity structure. They say, I'm in debt the same way they say, I'm in trouble. The language is shame-based. And shame, in finance, is expensive. What I want to do today is take the emotion completely out of it and replace it with a simple arithmetic question. When is debt making you poorer, and when is avoiding debt making you poorer? Because those are two different problems that require two different answers. And most people are using the solution to the first problem to answer the second question, and it's quietly destroying their long-term wealth. Stay with me, because in a few minutes, I'm going to show you what happens to two people who make the exact same income, have the exact same starting capital, but make one different decision about debt. And I want you to see the number that separates them at the end. It's uncomfortable. But first, let me give you the central metaphor for everything I'm about to say, because I'm going to come back to it over and over, and it's going to make all of this click. Think of your capital, the money you have available, as a truck. A truck can haul things for you. It can generate revenue. It can be rented out, loaded up, put to work. Every day the truck sits in your garage doing nothing. That's a day of productivity you've permanently lost. You can never get that day back. Now, a lot of people hear financial advice that tells them the goal is to own the truck outright. No debt on the truck. Free and clear. And that sounds reasonable. But here's the problem. If you spend 10 years laser focused on paying off the truck, when the truck only costs you 6.5% per year to keep on the road, and meanwhile, the truck could be out there hauling cargo that pays you 10% per year. You have just spent 10 years voluntarily driving yourself in reverse. You own the truck, and you are poorer for it. Your truck is in the garage. Your neighbor's truck, the one he still owes money on, is out earning. That's the whole video in one image. Let me show you the math. In a few minutes, I'm going to show you something that goes even deeper than the opportunity cost calculation. I'm going to show you how the wealthiest people in the country are actively using the financial literacy gap around debt as a mechanism to extract wealth from people who think they're being responsible. But let's start with the numbers, because without the numbers, the rest of this doesn't land the way it should. According to Fidelity, the S&P 500 average 30-year return from January 1996 through December 2025 was 10.4%. Let me say that again. 10.4% annualized over 30 years. That includes the dot-com crash, the 2008 financial crisis, the COVID drop, all of it. The average yearly return of the S&P 500 over the last 100 years comes to 10.4%, and that assumes dividends are reinvested. Now let me tell you about Marcus. Marcus is 40 years old. He just paid off his mortgage. He's completely debt-free. His house is worth $450,000 and he owns it outright. He has no monthly mortgage payment. He feels incredible. His friends are impressed. His mother's proud of him. He went on social media and posted a photo of himself burning the mortgage documents, which I'm told is a ritual people perform. Good for Marcus. Marcus also has no liquid capital to invest. He spent every extra dollar over the past 12 years aggressively paying down that mortgage. He did what the debt-free gospel told him to do. Now, he's starting from zero at 40 on building a real investment portfolio. He has 25 years until he wants to retire at 65. His brother Derek took a different path. Derek paid the minimum on his 3.5% pandemic-era mortgage, the one he locked in during 2020. And for 12 years, he invested every extra dollar into a low-cost S&P index fund. The current 30-year fixed-rate mortgage is averaging around 6.5% in 2026, but Derek's was locked at 3.5. Borrowing at 3.5 and investing where the market historically returns 10+% is not gambling. That's called interest rate arbitrage. That's what banks do, by the way, every single day. They borrow your money at 4% and lend it at 7%. The spread is the business model. After 12 years of investing the difference, Derek sits down at 40 and runs the numbers. He has a portfolio worth, let me be precise here, because I ran this approximately $260,000. That's 12 years of the difference between his mortgage payment and what Marcus was paying and invested monthly. He still has his mortgage. He owes about $240,000 on the house, but his investments exceed his debt. He has what one financial advisor I came across recently calls being debt-free but not paid off. His assets exceed his liabilities without ever having written a single extra check to the bank. And for the next 25 years until retirement, Derek's $260,000, growing at the historical 10% average, becomes, let me do the math correctly here because I actually care about not misleading you, approximately $2,800,000. That's what compounding does. Over 25 years, at 10%, $260,000 becomes $2.8 million. A portfolio that grows at 10% nominal for 30 years turns $10,000 into roughly $186,000 in nominal terms. Scale that up. Meanwhile, Marcus, starting from 0 at 40 with 25 years to go, needs to invest aggressively just to catch up to where Derek already is. Investing $200 a month starting at age 25 could grow to over $500,000 by retirement. Waiting until 35 to start might require investing $450 a month to end up with the same amount. Every year you delay compounds against you, not linearly, exponentially. The truck in the garage. Now here's where I need to address the thing you're probably already thinking, because I was thinking it too when I first looked at this. You're thinking, but Marcus's house is an asset. He has $450,000 in equity. Isn't that the same thing? No. And this is the reversal that changes everything. You think the problem is debt. The actual problem is illiquidity. A house is not a liquid asset. You cannot deploy equity to capture opportunity. You cannot move it into the market when prices drop. You can't call your broker on a Tuesday morning and say, sell $200,000 of my house equity. Money tied up in home equity is difficult to access without a sale or refinance. Money in a brokerage account is significantly more liquid. Equity locked in a house is like a truck that's been buried in concrete in your driveway. Technically yours, completely immobile. And this matters more than most people realize, because wealth creation almost always requires the ability to act when opportunity presents itself. The investor who had capital in March of 2020 bought assets at massive discounts. The person who had all their capital buried in their mortgage equity watched the news. By the way, hit subscribe if you like the content. YouTube's algorithm may never show you my videos again if you don't. And I put a lot of time into researching this stuff so you don't have to go read the boring documents. Now, let me tell you about the psychological mechanism that keeps smart people making this mistake for decades. Because this isn't about intelligence. It's about a very specific way the human brain is wired. That financial advisors, the ones who charge you 1% of your assets to explain half of what you need to know, have very little incentive to help you. Override. There's a concept in behavioral economics called loss aversion. The basic idea is that we feel the pain of a loss roughly twice as intensely as we feel the pleasure of an equivalent gain. Losing $50 hurts more than winning $50 feels good. This is well documented, been replicated hundreds of times in studies. Kahneman and Tversky built a Nobel Prize out of it. Now apply that to debt. When you have debt, you are psychologically experiencing it as an ongoing loss. That interest payment feels like money leaving. Every statement, every notification, every reminder that you owe someone money triggers a small but persistent anxiety response. Your brain is running a quiet alarm. And paying off the debt feels like stopping the bleeding. It feels like relief. The relief is so powerful that it registers as a win, even when, mathematically, it was a loss. This is the psychological machinery behind the debt-free movement. It's not irrational to want to eliminate that anxiety, but it is financially costly to let that anxiety override arithmetic. Here's a short story that illustrates this better than I can explain it directly. There's a farmer named Ray. Ray has 2 fields. He rents both of them for a flat fee. One field produces corn that sells for $10 a bushel. The other produces corn that sells for $6 a bushel. Ray gets a chance to buy out the lease on one of the fields, pay a lump sum, and owe nothing to anyone on that field ever again. He buys out the $6 field. Now he owns it outright, 0 debt. He feels great. He goes to bed every night with the psychological peace of full ownership. Meanwhile, the money he used to buy out the $6 field could have been invested in expanding the $10 field. Every year, he leaves $4 per bushel on the table compounding. Ray gets rich slowly. His neighbor, who kept borrowing to expand the $10 field, gets rich faster. Ray will tell you he made the smart choice because he can see his field and he owns it free and clear. His neighbor will show you his bank statement instead. The $6 field is your low-interest mortgage. The $10 field is a diversified index portfolio. And now I need to show you something that will make this even more specific, because there's a layer here about who exactly is profiting from the debt-free religion, and it is not who you think. Here is the part that never makes it into a retirement calculator. You can know all the numbers I've just shared, the 10.4% historical return, the opportunity cost, the liquidity problem, and still walk into your retirement having done everything right in theory, and then discover the gap between I have a number and I have a system. I found that gap personally. I had the math. I didn't have the framework. That's why I built something called the Exit Code. It's a digital book, 8 chapters, no filler, built on 50 years of actual retirement data. I distilled it because I couldn't find one resource that handled the full picture without either dumbing it down or burying you in academic language. 2 things in particular that connect directly to what we're talking about today. The first is what I call the 58% rule, the probability that your exit from the workforce won't be entirely on your own terms, and the buffer strategy you need to survive that without dismantling the portfolio you spent decades building. The second is the dynamic withdrawal method, which replaces the 4% rule that most financial advisors still use, a rule that was designed for a different market environment and has been quietly failing retirees who follow it too rigidly. The Exit Code is available through the link in the description for less than what you'd spend on dinner. Every year you don't have a system rather than just a number. The math in this video works against you instead of for you. Back to the debt question, and this is where it gets really interesting. Let's talk about what the wealthy actually do with debt, because the contrast is stark enough to be mildly infuriating. More than 7 in 10 Americans are in debt. The wealthiest aren't in debt. They use debt, said Howard Dvorkin, a CPA and chairman of Debt.com. That's not a motivational quote. That's a structural observation. Elon Musk regularly borrows against his massive stockpile of Tesla shares to support his other businesses. It's a common practice among the ultra-wealthy. Now you might think, okay, that's because they have billions. Normal rules don't apply. And that's partially true, the scale is different. But the mechanism is not. The mechanism is available to anyone who understands it. More financially sophisticated individuals use debt to acquire or retain assets, stocks, real estate, businesses. Debt is a tool for liquidity and tax deferral, which allows them to grow wealth. Here's the specific move that the ultra-wealthy make that the average financially anxious American never considers. You borrow against an appreciating asset at a low rate, let's say 4%. You take that borrowed money and put it into something that returns 7 or 8 or 10%. The spread, the difference between what you borrowed at and what you earn, is pure arbitrage. Borrowing against assets to get leverage is one approach. They might put up their real estate holdings as collateral on a loan at 4% interest, and then invest that money in government bonds. At 4.7 to 5%, they're then guaranteed to make money. That's a conservative example. With equities, the spread is larger. With real estate, the math can be even more favorable. The wealthy have developed several methods to utilize debt to their advantage, most notably because borrowed money does not count as income, it is not taxed. This is the part that almost nobody in the personal finance space emphasizes clearly enough. When you borrow, the borrowed money is not a taxable event. When you sell an asset to access cash, it often is. So the sophisticated move is hold your appreciating assets, borrow against them at a low rate, use the borrowed capital productively, pay down the loan with the income those investments generate. Your assets keep compounding. You never trigger a capital gains event. The IRS never gets a check. This is not a loophole. This is just understanding how debt actually functions versus how it feels. Leverage is using borrowed capital to increase your potential return on investment. It allows you to do more with less, keeping your own money in play while putting someone else's capital to work for your benefit. Now, let me give you the subplot that's been running quietly through everything I've just said, because it connects all of this to a very specific psychological trap. There's a man, I'll call him Gary, who has been listening to debt-free content for 12 years. Gary is 47 years old. He's done all the right things according to the conventional playbook. He paid off his car. He paid off his credit cards. He put extra money toward his mortgage every month. He has a net worth on paper of around $340,000, but almost all of it is his house equity. His liquid investable assets are roughly $42,000. Gary is rich on paper and cash poor in practice. Gary reads about an opportunity in early 2020 to buy the S&P 500 at a massive discount during the COVID crash. He has $42,000 liquid. He buys some. Markets recover. He makes a reasonable gain. But the guy across the street who had been investing in a taxable brokerage account for 12 years and had $400,000 liquid deployed $200,000 at the bottom and built a position that returned him approximately 40% over the next 18 months. That's $80,000 in 18 months, on top of a much larger base. Gary didn't lose the COVID opportunity because he made bad decisions in March of 2020. He lost it 12 years earlier, every time he chose to put an extra $600 toward his mortgage instead of into a brokerage account. The decision that cost him was invisible. That's the cruelest part. Your truck in the garage 12 years ago. Here's another angle that I don't hear talked about, and this one genuinely surprised me when I ran the numbers. According to a LendingTree survey, 34% of Americans believe that you cannot be considered wealthy while you have debt. 1 in 3 Americans thinks wealth and debt are mutually exclusive. That belief is not just wrong, it's specifically, measurably wrong. The Forbes 400 is full of people with 8 and 9-figure debt loads. The wealthiest real estate investors in America own thousands of units financed with enormous mortgages. Private equity firms build companies by loading them with debt on purpose. Leveraged buyouts involve acquiring revenue-generating companies, using borrowed money as much as 90% of the purchase price, and then selling the company 3 to 5 years later for a profit. The belief that wealth and debt are incompatible is a consumer class belief that keeps the consumer class exactly where it is. Let me give you a 2-part framework for thinking about debt clearly, because I think clarity here is more useful than another dramatic statistic. Part 1, what is the cost of the debt? Part 2, what is the return on the capital you'd be freeing up if you paid it off? If the cost of the debt is lower than the return you'd earn by investing that capital, paying off the debt early is a guaranteed way to make yourself poorer in the long run. If the cost of the debt is higher than what you can realistically earn elsewhere, pay it off. Full stop. This is not complicated. It's just arithmetic that nobody showed you because the emotional language around debt overwhelmed the math. Credit card debt at 22% interest, pay it off immediately. That's an automatic negative compounding machine. You cannot outperform a 22% guaranteed negative return. Total US credit card debt hit a record $1.277 trillion in the fourth quarter of 2025, according to the Federal Reserve. A significant chunk of that is people running a 22% negative return on their net worth every month. That is the debt that is genuinely destroying wealth. But a mortgage at 6.5% against a historical market return of 10%? The S&P 500 has averaged 10.3% over the past 30 years. After accounting for the mortgage interest deduction, the math slightly favors investing if you can stomach the volatility. The correct decision for most people with long time horizons is to hold the mortgage and invest the difference. A mortgage at 3.5%, the kind millions of Americans locked in during 2020 and 2021, do not pay off a 3% mortgage. Early invest instead. At 3%, your after-tax cost is roughly 2.25 to 2.5%. The stock market historically returns 10% plus. You are borrowing at 2.5 and can earn 10. That's a 7.5% annual spread in your favor. 7.5% annual spread on whatever capital you have every year, compounding for decades. This is not speculation. This is 48 months of central bank data and 100 years of equity market returns pointing in the same direction. The truck is parked. You could be renting it out. And this is the kicker that I want to leave you with before I give you 3 things you can actually do with all of this. Fewer than half of Americans, 43%, consider themselves financially secure. Gen X reports the highest insecurity, with 54% saying they don't feel financially secure. A lot of those people are not financially insecure because they have too much debt. Many of them are financially insecure because they spent their peak earning years destroying wealth quietly, in slow motion, by avoiding the productive kind of debt, staying asset poor and cash poor, while calling it financial peace. The most dangerous financial mistakes are the ones that feel virtuous while you're making them. You know what Gary said when I walked him through this? He said, "I thought I was being responsible." And he was in the way a person is responsible who carefully polishes their shoes every morning and then walks to work in the rain because they were too focused on the shoes to notice they should have bought an umbrella. Being meticulous about the wrong thing is still the wrong thing. Now, one last thing before we get to takeaways. Gary, our subplot friend, is sitting at 47 with $42,000 in liquid assets. He's not ruined. He has time. Not as much time as he would have had, but time. The question is whether he changes the framework now or spends another decade doing the same thing in the same direction. He's currently, as of this year, putting extra money toward his mortgage at 6.4%. His brokerage account earns historically 10%. He is voluntarily giving up 3.6% annually on every dollar he deploys toward that mortgage versus the market. On $100,000, that's $3,600 a year in foregone wealth. Over 20 years, with compounding, that gap grows to something that will make him genuinely sick when he calculates it. The truck, the garage, still parked. He just repolished it. 3 practical takeaways, and I mean specific and calibrated to this topic, not generic invest early boilerplate. 1, run the spread test on every dollar of extra debt payment you're currently making. The math is simple. Your debt interest rate minus the historical return of a diversified index portfolio. If the spread is negative, meaning your debt costs less than what the market historically returns, redirect that money to investment immediately. Do not wait. Waiting is the compounding problem. Every month you delay is a month of that spread you've permanently lost. The only exception is if you have less than 3 to 6 months of liquid emergency fund, which should always come first before you do anything. 2, redefine what debt-free means. Stop using it as, I owe nothing to anyone. Start using it as, my investable assets exceed my total debt. When investable assets equal or exceed total debt, and your debt is priced below what your investments earn, you are functionally debt-free in every way that matters financially. The reason not to pay off the debt is because the cost of that debt is much lower than what the investments make. This reframe is not semantic. It is the difference between how wealthy people count net worth and how anxious people count debt. 3, if your mortgage rate is above 7%, which some people locked in during 2022 and 2023, the calculus genuinely shifts. If your mortgage rate is under 4 to 4.5%, it doesn't make sense to pay it off. Anything 7% or higher, you should seriously consider making extra payments. The range between 4.5 and 7 is judgment territory, based on your time horizon, your risk tolerance, and whether you'll actually invest the alternative capital or just spend it. Be honest with yourself about that last part. Lazy investing built more fortune than crypto memes. And the people who figured that out were not geniuses. They were just the ones who realized that the feeling of zero debt and the math of zero debt are two completely different things and chose the math. Note de bas de page. Les chiffres de rendement historique du SP5 cents sont cités à titre informatif sur la base de données historique. Les performances passées ne garantissent pas les performances futures. Ce contenu est éducatif, pas un conseil financier personnel.